Hello, me Haresh with my teammates Satyam and Rithika. Today I want to elaborate on a case study for the Case Championship 2025 EY Cafta. So basically we have assumed a company ABC Pharmaceuticals. So how a multi-million company manages all of the dollars all over the planet. So the basic question comes how on earth does a massive global company keeps control of 20,000 crore spread across 4 continents. So we have assumed the turnover of the company as 20,000 crore which flowed across 4 continents: India, USA, Nigeria, Europe, and 60% of its revenue come as USA dollars and have to pay money in rupees, euros, and Nigerian naira, basically spread over the different currencies. To solve this problem, we have gone to this currency risk strategy for Nigeria pharmaceutical effects, assuming the key market statistics, and for the mitigation, we have done a strategic framework with diversified hedging, enabling sourcing production, considering all the regulations, supply chain optimization, and digital predictive analytics. So implemented that with phase wise in 4 different phases. Also, the instruments and strategies to manage the currency risk, or do the with the forward contracts, options, currency swaps, and everything, and the matrix of KPI and assess hedging effectiveness with different ratios and to hedge coverage ratio effectiveness, and we have recommended some enhanced hedging effectiveness.
Now let's
Over to you,
have a
Satyam.
look at USD INR 6-month strategic forecast based on augmented interest rate parity framework, considering factors like interest rate differentials, inflation expectations, and risk sentiment. The key variables impacting the model include growth differentials, commodity prices, central bank policies, and capital flows. The key CFO takeaways include practical trading takeaways such as risk management, monitoring global drivers, tracking central bank actions, and staying adaptable with the strategy. Moving forward, GenAI, how GenAI helps reduce the currency risk in pharma industry is shown it shows that due to rupee depreciation, the company's unhedged loss is rupees 141 crore, but with GenAI's 80% hedge coverage, the loss reduces to 28.27 crores, helping protect the profit margins
Satyam.
and ensure
Moving on to
financial
the
stability.
further solutions. Forecasting and monitoring for short-term cash flows across the geographies can be done in 3 ways, that is 13-week rolling returns, regional consolidation, and global treasury consolidation. Cash pooling across subsidiary can be done in 2 ways, that is physical sweep and notional pooling. The opportunity to improve a cash conservation cycle can be done in 3 ways, that is DPO, DSO, and DIO. The treasury technology that can be used further is done in 3 parts, that is real-time cash visibility, which is divided in tier 1, tier 2, and tier 3, and cash forecasting model can be used in which direct, indirect, and AL and ML productivity are used. Then the state-of-art policy for investing can be done in 2 ways, that is guiding principle and investment horizon, which includes operational surplus, strategic surplus, and long-term surplus. The investment decision that can be taken to complement with company's risk appetite is of 3 ways, that is IFRS 9 compliance, SOX controls, and global regulatory adherence. And for optimizing portfolio allocation can be done to maintain the right amount of liquidity from T-bills, corporate bonds, and liquid fund debt like ICICI Prudential short-term fund, which basically yields essential range. Assuming that it is 100 CR, it can be divided into short-term, mid-term, and long-term.